We hit an all-new record closing high yesterday. 30 minutes till the start of the cash trade today. I'm Matt Miller. Dani Berger is on assignment. Open interest starts right now. Coming up, a Santa Claus rally tries to take hold as global stocks eye records and the U.S. market sets its first all-time high in 6 weeks, as judged by the S&P. But caution in the tech sector remains as Broadcom falls short of lofty AI revenue expectations and a plan to water down UBS capital demands, or Swiss capital demands on UBS, sends those bank shares to a 17-year high. We're going to focus in on what's going on there. Stocks to watch today include Broadcom. As I said, it is down after its sales outlook for the AI market failed to meet heavy expectations. We have the shares right now down about 5.5%. It has a backlog of AI orders totaling only, I guess, $73 billion over the next 6 quarters. Lululemon is actually higher in the pre-market as it sees solid holiday demand and announced CEO Calvin McDonald will step down in January. That's probably more important to shareholders and why we see the stock up 10%, because they see a reset now as possible. Let's start off, though, with Broadcom and the AI trade. Bloomberg Tech co-host Ed Ludlow joins us from San Francisco. And Ed, it's interesting. On the one hand, the market is concerned about CapEx that's just exploding. On the other hand, they want to see the backlog and revenues at Broadcom higher.
The market always wants more, and it's more a piece of tangible, forward-looking data. So Broadcom offers custom chips. In the context of what's happening in AI and data centers, they are the IP and engineering partner on Google's TPU, for example. This figure, $73 billion AI-specific backlog, is over the next 6 quarters. And the narrative from the company to its investors was, this is a minimum number. But what the street was quite clearly looking for was the next step of that, which is we're very used to backlogs in the chip industry. Tell us in the next calendar year how much revenue you're actually going to get through, how much revenue you're actually going to book through that backlog. And it just wasn't enough. The stock down almost 6% in pre, but I think we make the obvious point, Matt, that this is a stock that's up almost 75% year to date going into it. And that's an important factor.
Ed, we also have news that China is going to put about $70 billion of the stimulus into its own chip development. Is that a big number? Because it does, not yet meet the CapEx of some of our individual megascalers for the year.
Yeah, that's certainly probably the right way to look at it. 70 billion as a basic minimum example is far beyond what the CHIPS Act provided for in terms of government-backed funds for the chip sector in this country. China already has some vehicles and investment funds that are specifically semiconductor related. And what I would say is, based on our reporting, $70 billion seems to be like an upper bound. Where they settle, it could be less than that. It could be near to it or more than that. The assumption is that it's Huawei and Cambricon that will benefit from these funds. But really, there's a lot we don't know. We don't know specifically which companies China hopes to support most, and sort of what the mechanism is here. Is this literally to support R&D, or, as has been the case in America, a great infrastructure build-out or capacity build-out? Those are 2 different things, right?
Ed, I look forward to your program today because there's a lot, as usual, for you to talk about. Bloomberg Tech co-host Ed Ludlow talking to us about Broadcom and what we see in terms of Chinese stimulus. Lululemon shares climbing after that company boosted its full-year EPS guidance on strong holiday demand. But maybe more importantly, Calvin McDonald, the CEO, will step down in January. Romaine Bostick, co-host of The Close, whom I would bet has never worn yoga pants, joins us now.
You would actually be wrong, believe it or not.
Oh, no.
Yeah, I went through a phase, let's just say.
Yeah. All right, let's experimenting in college, I guess.
Sure.
Let's talk about why the reset is so important to investors. I mean, this stock is up 10% on a CEO exit.
Yeah, this is actually going to be one of the best days for the stock in months, probably going back to April. But just to put it into perspective, Chip McDonald took over in 2018, and he actually did a pretty phenomenal job in the early days. He took this from a company with less than $3 billion in annual sales to one with almost triple that today. The stock price soared like like 50%. The problem is this company kind of peaked back in 2023. The stock is down 63% since then. Sales growth has basically been stagnant to down. In fact, they had double-digit comp sales growth pretty much through most of this tenure, but the last 7 quarters have all been in the single digits, Matt. And more importantly, not just in the single digits, but no real signs of improvement, despite some of the numbers that we got last night.
We actually were talking with Stephen Yalof of Tanger, and, you know, Dani was like, I guess Lululemon's not so hot because they have these really high-end competitors, not Nike and Under Armour, but like expensive stuff, right?
Yeah.
And Yalof said, no, they're actually doing great.
Well, I think analysts would disagree, and several analysts have already basically put a lot of pressure.
At his outlet stores, let's be clear, at the outlet stores.
But this has been part of the problem. You remember Lululemon was always, at least in the early days, considered a very high-end, premium type of brand, and there's been a lot of criticism that McDonald's maybe took it down a little bit too pedestrian. They created partnerships with Disney, putting Mickey Mouse logos on pants, putting NFL logos on some of the products as well, and a lot of people thought this was taking a little bit of the cachet out, and particularly at a time where you had sort of the Fiore and Alu and all these brands come in that sort of have now the same cachet that Lululemon once had maybe 10 years ago. And of course, Chip Wilson, the founder, who still is the largest individual shareholder, he has been just vicious. If you ever want to have some fun, go through his LinkedIn account. He's basically spent the last couple years just trolling management.
Dude, by the way, unrelated, I wonder what you think about using NFL logos, because for years, Breitling has been doing this, and it always seems to me that maybe it cheapens the brand a little bit, but obviously the NFL has such big cachet in America.
But that's the concern. But does it broaden out your reach? Sure. But at the same time, it also brings in a different customer that maybe doesn't want to necessarily pay, you know, $100+. The other issue too is they've had a lot of issues with regards to just fashion. McDonald's just recently finally hired a new creative director, but he's not going to really have time to bring that person in. But also remember, they had a couple missteps. Remember last year they had those breeze-through leggings that were apparently a little too breezy. And so a lot of women just decided they didn't want to wear them. They had the other one with the little V-shaped seam that was unfortunately very misplaced. So there were some huge missteps that they took on the fashion side that whoever the new CEO is, they're going to have to find a way to address. And we should point out, they do not have a new CEO.
All right, Romain, great wrap up. Look forward to your program today. Romain Bostick anchors the close, and he presided over an all-new record high yesterday on the S&P 500, more than 6,900, I believe, at the close, 6,901. Let's turn to the broader market, because U.S. stocks, this morning they're drifting lower, but we are at such lofty heights. European equities are also hovering near all-time records. Strategists are betting on further gains before the year ends. Karen Georges of EcoFi Investments writes, quote, "Everyone is convincing themselves that there will be a Christmas rally, so it looks like there will be one, and to be honest, there's no negative catalyst visible until the end of the year." Joining us now is JP Barnard, Bloomberg senior market strategist out of Frankfurt. So, JP, it does look like, even though, as you know, Romain was on yesterday, they hit a record high again on the S&P, and of course the president of the United States has been touting the Dow Jones Industrial Average. We could continue to climb into the holiday.
Yeah, absolutely. I mean, and I'm totally with that statement that there is no negative catalyst or no obvious negative catalyst on the horizon right now. Right now, we have moved through the Fed issue and kind of a little bit of the macro data. I mean, there's still more to come, but it looks all right. And what you're seeing with like stocks is that they take this to the heart. And I mean, the AI trade is still on pause for now for good reasons. But we're seeing a cyclical rotation, and stocks are really like embracing the idea of like there is no danger on the horizon right now. The economy is doing fine. The job market is doing fine. The Fed gave us kind of what we wanted, and from there, like I mean, like seasonality is on your side, and so I guess from next week on, it could well be that we get that center rally as we have seen so often before.
JP, I don't know how much you're focused on the concentration risk. You know, in Europe, it's not the same thing that we have here in the U.S., but has there been a broadening out? It seems that big investors that we talk to have differing opinions on this.
Well, I guess it depends on how you want to look at and what's your starting point. Of course, I mean, like we still have a big concentration, and that's probably not going to go away unless, like, I don't know, Apple and all the Magnificent Seven will be cut in half, and that's not going to happen. I like to predict, but what we are seeing is that the market is like not so keen anymore to jump on everything that has AI on it, and that of course like automatically removes a little bit of the concentration. I mean, that trade is still big, and it's going to be big in 2026 for sure. But The thing is like that the market is now a little bit more focused, asks more nuanced questions, is focusing on like, okay, where does this trade actually make sense? Who is going to be the best bet on it? Who is going to make the best money? Who is fastest to implement all the AI ideas that are floating around? And I guess like we are not going to see that pure let's buy NVIDIA all the way up just because of we like it, but people are going to be a bit more nuanced going forward, and I guess that's automatically going to have a market that is more broad and that's not so one-sided as we have seen, quite frankly, over the last 3 years, actually.
JP, you know, American investors eyeing European outperformance with a little bit of envy. I mean, the DAX, where you're sitting, is up 23%. Here in the U.S., the S&P is only up 17%. But if you're a dollar investor, you're up 38% in Germany. You're up 46% on the IBEX in euros, 66% in dollars. Is that kind of outperformance set to repeat itself in 2026?
Probably, I guess so, because like the question is like when the Fed is really like moving with interest rates in one direction and the whole world is moving in the other direction, kind of, or at least hold steady, then this needs some wealth to explore itself into the market, and that usually is then the foreign currency market and the dollar. So I guess like most people are. Or the consensus is that the dollar is probably going to have a hard time to really perform, and that means like it's going to be a better place for all the assets outside of the U.S. Will that lead to like an outperformance that we have seen this year? I'm not so sure about it because, like, I mean, Europe also, that's why I was shaking my head a little bit. It also has kind of a concentration problem a little bit. And we have seen like trades like defense doing really, really well. So Europe has to prove that it really has its place to be. But I guess like overall for investors, diversification is something that they want to have going forward the next 12 months. And that should usually help like all the markets outside of the U.S.
Yeah, I mean, the banks are a standout example. In Spain, you're up 66% in 1 year, but it's mostly the banks that are driving that. We're going to talk about that on the other side of this block. JP, thank you so much for joining us this morning out of Deutschland. Quick check on what's going on in futures here in New York. We're looking at really on the S&P, but we hit over 6,900 yesterday at the close. NASDAQ futures down about 0.4% as that AI trade comes into question again. Looking at some of the other movers on our radar this morning, Costco profits topped expectations as price-sensitive shoppers search for value. That place has been packed in Yonkers, I can say for sure. Restoration Hardware reported higher growth than rivals as the industry contends with tariffs and a sluggish housing market, but rich people still buy expensive furniture. And pot stocks jump on news that President Trump is expected to direct his administration to reclassify Mary J. as a less dangerous drug. Tilray also announced a new product line. Coming up, UBS jumping this morning as Swiss lawmakers pitch a watered-down version of proposed capital requirements. We'll talk about one of the most important bank employers in the world. This is Bloomberg Open Interest. Let's get out of high interest and look at what's making headlines around the world. President Trump is moving to shift marijuana into a less dangerous drug category, reclassifying it from the strict Schedule 1 category to a Schedule 3. The move signals a major shift in federal drug policy. Reclassification would make it easier to buy and sell cannabis and could ease tax burdens and some obstacles for companies and investors in the sector, but they still wouldn't be able to bank. You can see, well, you saw there, they were all up. Here they are again. For students filling out financial aid forms, also probably concerned about the legality of marijuana, some colleges might now come with a warning. The Education Department is adding a new earnings indicator to the FAFSA. When students file, some colleges will now show a red flag if their graduates earn less than other high school grads, with the cost of attending college reaching $100,000 a year in some places. More people are questioning the value of that higher education. And UBS shares are hitting a 17-year high after a group of influential Swiss lawmakers proposed watering down the capital requirements for the bank. The proposal would allow UBS to use junior debt, so-called AT1 bonds, instead of equity to meet the capital requirements. And to talk about this, I want to bring in our chief Wall Street correspondent, Sridhar Natarajan, joining me over here at the desk. Sri, this is an important story on so many levels, especially for our viewers and clients. But first of all, it means UBS probably won't move to New York, right?
So the lesson from that is perhaps playing hardball works. And we should remind our listeners and viewers as to why we're even talking about UBS in New York. Not that it has ever been floated as a serious proposal, but in the last few weeks and months, there has been a lot of murmurs and rumors and talks about UBS, senior ranking UBS executives talking to US officials, potentially relocating their headquarters out of Switzerland, which would be a big hit for Switzerland because UBS is the last remaining globally significant bank in the country, a country that is built on its banking system. What we have today is a group of influential Swiss lawmakers trying to find a compromise. And, you know, the details, there are some details here, but the details at this stage truly are not relevant because these will still be debated a year and a half down the line. We're talking about debates in 2027. But the idea is to make sure that they get to the negotiating table because up until now, the Swiss government was taking a very hardline stance, which would have meant that UBS would have had to set aside $26 billion in additional capital to meet their demands for a safer banking system. And UBS had been saying that would simply not be acceptable because it would make them uncompetitive.
By the way, UBS shares apparently rise to a 17-year high, and they have returned, well, they've tripled in the past 5 years, but they're not doing as well as Goldman Sachs over that period, not doing as well as Deutsche Bank over that period, not doing as well as HSBC, and I haven't even looked at the Spanish banks, which are killing it. What's going on with this insane bank rally, like all across the globe?
Well, you know what's happened this year is we've finally seen a big return in deal-making activity. You've seen that even as this has happened and people are worried about where the economy is headed, could there be a turn in the economy? When you look at the actual underlying numbers right now, the biggest banks are not that concerned. They're talking about a resilient economy. Their consumer banking operations are doing fine. And when you talk about the investment banking side of things, when you have so many deals in the pipelines, major deals, there is a flow-through effect into other parts of that investment banking business. It's not just fees from advising on the biggest deals. It's raising debts, it's issuing equity. And there is also obvious trading activity that you will get from all of this business that the investment bankers are bringing in. So right now, it is a good time to be a major bank that is globally significant.
Especially in Spain. I just looked up Santander. In the same period, over 5 years, they've returned, with reinvested dividends, 353%. Is there a bubble in bank stocks? Are we worried about the wrong bubble here?
Wow, we're now trying to find bubbles everywhere. Look, when you think about what has happened in some of the more exuberant parts of the market, it is very hard to look at the banking sector and talk about bubbles. And let's bring back the conversation to why we're even talking about the banks today. It's the strict capital demands. And there is this sense that in the last 15 years, regulators have acted in a way that has made the banking system safer. And that's why in the last year or two, more of the conversation is about what is happening in the non-banking system and are there enough eyes on it and are there enough guardrails placed out there. So not saying that nothing could possibly go wrong with banks, but on the surface, there's no obvious sign that banks are in some sort of bubble territory.
I just put a smattering of the big ones here, and you can see JP Morgan is the worst performer among all of these big banks. If you can decipher the tickers, those are UBS, JP Morgan, Goldman Sachs, Deutsche Bank, HSBC, and Santander. Sri, great talking to you. It's a really important story for investors right now, and especially also for employees of UBS. Sridhar Natarajan covers global Wall Street for us. Check on futures ahead of the bell after a bang-up session yesterday. We're looking at a lackluster session coming into the start of this Friday, at least for S&P futures, really not moving there. You do see NASDAQ futures falling. When we come back, we'll talk with, about the expected Santa Claus rally, maybe that we're already seeing with Ulrike Hoffmann-Burchardi of UBS Global Wealth Management. This is Bloomberg Open Interest. Goldman Sachs is the latest to boost its S&P 500 forecast. Strategists there see the benchmark hitting 7,600 in 2026, a nearly 10% upside from Thursday's record close. Those analysts cited AI adoption across industries, fewer tariff headwinds, and productivity gains. Let's bring in Ulrike Hoffmann-Burchardi, CIO for the Americas and Global Head of Equities at UBS Global Wealth Management, which is obviously a very large wealth management. AUM must be tremendous. Business must be crushing it, especially with this new record, not just here, but around the world. Do you see us continuing higher from here?
Yeah, we actually think that this week is a little bit of an early read onto the two dynamics we think are going to shape 2026. One is supportive policy, and then an AI story that is now pivoting from CapEx to cash flow. And I think both of these dynamics support a broadening equity market, but also a higher equity market into next year.
Is the AI bubble concern not one that you share?
I think whether it's an AI bubble or whether valuations in those stocks are high, for me is largely definitional. The question really is about fundamentals. Valuations are never a cause for a stock market correction. It's just they show you the amplitude of a potential correction if fundamentals disappoint. If we go back even to the 99, the heydays of the internet, we saw NASDAQ valuations peak in December 98, and yet the NASDAQ increased by another 100% after. So again, you need fundamentals to change. In 2000, there was the loosened profit warning. It was the Fed hiking rates. And it was also dot-com companies running out of cash. And I think none of these conditions are here right now.
All right, I'm going to save the banks question because I have viewers writing in saying, hey, can this rally in European bank stocks last? U.S. bank stocks have done very well as well. And it's, I think, a big part of maybe future growth. I'll ask you. Ulrike Hoffmann-Burchardi is staying with us. Check on futures ahead of the opening bell. On the S&P, not a lot going on, but on the NASDAQ, because of Broadcom earnings, because of China stimulus, we're looking at a drop in futures of about 0.5% on this Friday morning. This is Bloomberg Open Interest. We are moments away from the start of trading. This is Bloomberg Open Interest. I'm Matt Miller. Quick check on what's going on. Really, NASDAQ futures are where you want to pay most attention because we're seeing the biggest move there, down 0.6%. S&P futures are down a little bit, but you know, we had all new record highs on the big benchmark indexes. The S&P 500 closed over 6,900 yesterday, and so a loss of 0.2%, maybe not a huge deal. Chipotle, which has had a very tough time ringing the opening bell at the New York Stock Exchange, CMG, the ticker there, and it's really a huge part of the whole K-shaped economy narrative and whether or not you still want, I think they call them slush bowls, or someone in the control room, slop bowls, whether you're still into that or now you want a handheld sandwich again. We have Wealthfront ringing the opening bell at the NASDAQ marketplace, which is very cool because the CEO is going to come and join us in a little bit. And this is at least one of the companies that has really changed the money market industry, an irreversible shift for younger generations that are using it basically as a checking account these days, and just looking at more than $8 trillion now in money market funds. In terms of stocks to watch, Broadcom is one of the big weights on the NASDAQ. It'll be a big weight on the S&P as well, as this company has gotten ever bigger and done ever better. But now investors say not good enough when it comes out with its outlook for AI. The backlog was 73 billion. That's over 6 quarters. They said that's at the minimum, but investors want to see more. Lululemon is higher as it sees solid holiday demand. We heard that from Stephen Yaloff at Tanger, although that's an outlet store and maybe that's part of the problem. The CEO, Calvin McDonald, is going to step down in January. Investors may be worried he's brought it a little bit too mainstream, and they want to see a reset. So the shares are up almost 13% in the early trade. And we're back with Ulrike Hoffmann-Burchardi of UBS Global Wealth Management. Ulrike, I wanted to talk to you about bank stocks. It's been a focus of ours the last couple days because they've outperformed by so much in Europe. They've done very well here in the U.S. as well. And how much of that is part of, the broadening out trade? It's not just these 7 hyperscalers or top 10 stocks that you want to buy, but you're getting into other things like finance.
Yeah, when we look at the macro, maybe just to step back, then we see this dual engine of both monetary and fiscal policy that's now coming together. We saw the Fed, of course, lowering rates by 25 basis points again. Not only that, but also adding liquidity by buying T-bills. And then we have the fiscal stimulus that in particular is going to apply for the first part of next year with the tax refunds, helping the consumer, but also the delayed spending from the government shutdown. So all cyclically very positive conditions for financials. And then you have on top of that more room for deregulation. You have also increased capital markets activity that we think is going to happen next year. So we like financials as a sector together with technology, but then also increasingly healthcare as a diversifier to both of these.
So you really do see a broadening out. It's not just these, top 10 biggest companies that are growing earnings at a double-digit clip. What do you expect from earnings for the whole market in 26?
For the whole market in 26, so first of all, our price target is 7,700, 305 earnings, and probably a broader distribution of earnings within the other sectors. Again, in particular, we think the AI trade may be broadening out within technology, but also across other sectors. We have seen this week 2 more data points where just CapEx or just backlog in orders for AI infrastructure are no longer sufficient to drive stock prices higher. So we think actually the value may now increasingly accrue in the application layer of AI. So those companies that are using AI to actually drive margins and increase cash flows. And we think financials and also healthcare both actually have the potential to use AI with their very unique and proprietary data sets.
In financials and healthcare, we hear a lot of optimism there. In software, there's so much pessimism. That AI is. Howard Marks was out with a note a couple days ago saying that AI is going to replace software engineer or coders' jobs. I actually heard an interesting anecdote from Reid Hoffman yesterday. He was speaking at the Economic Club of New York. He said, he thought radiologists were all going to lose their jobs because AI was so good at detecting cancers in screens. But it turns out that screenings just shot up like exponentially. So now we have an undersupply of radiologists. How do you think it's going to fall in terms of job killer versus production driver?
I mean, what we do see right now in the labor market, right, at least anecdotally, that the parts of the labor market that are weak are also the parts where actually AI captures most value. So software engineering, right, technology is relatively weak when it comes to the labor market. Then we also see areas of marketing, customer service being weak. So we don't have a full empirical study yet, but I think anecdotally there seems to be some correlation. And actually that for us makes us more skeptical on the labor market going forward, maybe similar also to Fed Chair Powell's comment that we think the labor market may remain sluggish and the Fed actually may cut, we think, at least one more time in the first quarter, whereas the economy could potentially even accelerate in this environment. So a pretty unique setup if you think about it, and something that is, of course, very benign for the equity markets.
Is inflation a concern for you? We're going to talk to my editor-in-chief emeritus, Matt Winkler, at the end of this program. He has an op-ed out saying, look, the average consumer in America is paying an extra $1,000 at least because of tariff effects. Is that a concern for you, especially with a Fed that's cutting rates?
We don't think so. We actually think there are 3 disinflationary forces next year. First of all, we're going to anniversary the tariffs right in April. Then we also see the labor market still being weak, so wage inflation coming down. And then shelter inflation, of course, always has a lag, so that's still coming down. And even if the economy starts to accelerate again, shelter inflation could still stay low because of its lag. And then we see still wage inflation coming down because of potential AI replacement. So for us, that makes us actually on the inflation side relatively optimistic that inflation is staying contained. And also that gives, of course, the Fed more room to cut.
What do you think about the U.S. versus other markets? I was talking with J.P. Barnard, our reporter in Frankfurt earlier, about the incredible outperformance that we've seen, even if you take out the currency effects in Europe versus the U.S. Our investors are, the high net worth individuals that put their money with you really still interested in broadening out and diversifying further?
No, I think this is a theme that we are continuing to watch. We do think because the U.S. economy, the largest economy in the world, is still very strong in economic growth, poised to accelerate next year, that will also be a good backdrop for global economic growth. And of course, we also see stimulus coming out of Europe. So we are broadly positive, not just in the US, but also in Europe and parts of Asia.
What are the big risks, Ulrike? I hate to ask you, this is my last question, you know, getting ready for Christmas. What are the things that keep you up at night?
So with valuation being as high as they are, I think there has to be more scrutiny on the risks. And typically the risks, in my view, lie where the capital is most extended, and that is AI, and it is also government debt to a large extent. So we watch those areas carefully. On AI in particular, we don't see any immediate warning signs. AI adoption is trending higher. AI spending plans are still there. But there are, of course, risk with this amount of capex that we're seeing. And then on the government side, of course, we have record deficit levels. We have record debt to GDP ratios. But again, if we look at the macro conditions that are most helpful in this environment, which is elevated but contained inflation, rates that are benign, and then economic growth, those are the conditions that historically at least have helped to contain the budget deficit.
Will rates stay benign? Are these spreads going to stay so tight?
For the time being, we think so.
All right. Great having you in here. Really appreciate you joining us on set. Ulrike Hoffmann-Burchardi there from UBS Global Wealth. Let's get a look at what's going on in the market. Almost 10 minutes into the session here. We do see the S&P down, but only 3 points. So honestly, not a lot of movement, especially if you consider yesterday we closed at 69.01, so an all-time high. Right now we're at 68.98, so just a stone's throw, obviously, away from that. In terms of the point additions, you're going to see, obviously, the biggest stocks here, but Tesla leading the pack there ahead of NVIDIA as it bounces back, Apple, Netflix, and GE, Google, UNH. On the downside is where you see the earnings story coming through. So Broadcom is one of the concerns this morning. Yesterday, it was Oracle, and Oracle is down again today, but only by about 2%. By the way, yesterday, I think Larry Ellison lost yesterday $25 billion of personal wealth with the 11% drop in Oracle shares. Still, he's made an extra $95 billion this year, so don't cry for this, the big stakeholder in Oracle. In terms of the industry groups here on the day, we're looking at materials, consumer discretionary, real estate, and utilities doing the best, so it's kind of a defensive leadership here, but this is interesting that you have so many sectors up. In fact, Joe, did we reset this? So many sectors up, and yet... yeah, that's amazing. So almost all of the sectors up, 9 out of 11, and still it's IT and energy. These drops, as slight as they are, enough to drag down the broader index. Okay, it's only off by a fraction. Coming up, Broadcom shares slide as investors look for a bigger AI payoff. More on that earnings report and the state of the industry next with Mandeep. This is Bloomberg Open Interest. Time now for our top call. Some of the analyst action in focus this morning. First up is Jefferies upgrading Lululemon after the, wannabe upscale retailer boosted its outlook. I guess it's fair to say still pretty expensive stuff. And reported encouraging holiday trends. Lululemon is also shaking up leadership after a sluggish year with its CEO planning to step down in January. You can see the shares up almost 13%. Next up is JP Morgan boosting its view on Citi. The analyst says Citigroup is set to benefit more than peers from a firm economy and stronger markets activity into the new year, and Citi shares are up a little more than a third of 1%. Finally, Guggenheim is upgrading Bristol-Myers. The firm says the pharma giant is headed into a catalyst-packed 2026 with low expectations, rising royalties, and a sturdy dividend. Guggenheim sees the stock slump as a buying opportunity, and investors are doing that today to the tune of 3%. Broadcom shares in the red as its AI sales outlook disappoints. Joining us now to talk about this is Mandeep Singh, Bloomberg Intelligence Global Head of Technology Research. And Mandeep, I'll say the same thing to you that I said to Ed Ludlow. You know, on the one hand, we're scrutinizing these hyperscalers because we're worried that they're spending too much. On the other hand, a $73 billion backlog is not enough for us at Broadcom.
Yeah, I think in the case of Broadcom, if you parse through the backlog, it's all tied to Google TPUs. And that is where, everyone is comparing what happened with the Apple exposure when it comes to the non-AI side of their semi revenue, too much dependence on Apple. And the same thing is happening here when even Anthropic added $20 billion of orders. They are using Google TPU design. So from that perspective, the ecosystems are forming where it's pretty much a duopoly at this point of time. Either you're using NVIDIA or you're using Google TPU. And in the case of Broadcom, 90% of their AI revenue is tied to Google TPUs. So even though they talk about OpenAI as a potential new customer with up to 10 gigawatt capacity, it seems very unlikely that any of that backlog will translate into revenue before 2028 or 2029. And that's where I think the dependency is what's hurting their margin expectations. And that's why you see that sort of a stock reaction today.
The Google TPUs sort of emerged as a threat potentially to NVIDIA's Blackwell chips and whatever's coming next. What does Broadcom have in terms of that kind of competition?
Well, so Broadcom really is working with Google, to be their partner when it comes to designing their TPUs. They're providing certain components for the accelerator, and they are ultimately liaising with all the suppliers to get the chip made and manufactured by TSMC. But when it comes to other ramp-ups, like from Meta or some other customers that they had talked about in the past, it seems like those haven't really panned out in a big way. In fact, we have heard Meta may end up using Google TPUs as well. So there was a lot of chatter about 2 new customers up until the last quarter that may be ramping up at Broadcom. But it turns out one of them was Anthropic, and Anthropic in turn is using Google TPUs and not really designing their own chip. The only one that had talked about using their own chip was OpenAI, but it sounds like that effort is likely going to get pushed out to 2028, 2029 before they can ramp up significantly. So from that perspective, all of Broadcom's $30 billion plus in AI revenue is mostly tied to Google TPUs at this point of time.
All right, Mandeep, thanks so much for joining us. Mandeep Singh there of Bloomberg Intelligence talking to us about the chip wars. And don't miss, by the way, a conversation about AI policy with White House Special Advisor David Sachs. That's on Bloomberg Tech at 11:45. Will be, no doubt, a fascinating interview. And let's get a quick check on 3 stocks we've been watching all week. Warner Brothers is up about 14% this week. Netflix is down, well, this is the intraday move that you're looking at, but Netflix is down 4% over a week, and Paramount is actually gaining. We're keeping an eye on the race to buy Warner Brothers, and to clarify the deal terms, $5.8 billion will be paid by Netflix in the event that the deal does not pass regulatory muster. But if Warner Brothers were to choose, shareholders were to choose to go with Paramount, Netflix would get paid $2.8 billion by Warner Brothers. So it all comes down to who does the breaking up. Coming up, President Trump plans a push to reclassify marijuana as a less dangerous drug. We'll take a look at some ETFs that could shoot higher. Well, some that have done pretty well year to date. This is Bloomberg Open Interest. This is Bloomberg Open Interest. I'm Matt Miller. Quick check on what's going on in stocks. 21 minutes after the bell, we see the S&P 500 down 0.25%. Reminder again, it did hit a record high at the close yesterday, 69.01, that level. The Nasdaq down almost 0.75% today, and the problem really is Broadcom earnings. We had a little bit of a rebound in NVIDIA shares but they are now back in the red. Down only 0.1%, but it's a very heavy company, and Broadcom losing almost 1/10 of its value. Costco is off after earnings, only 1/3%, and we really do see encouraging signs for these big box stores that higher end consumers are moving down. Lululemon getting a huge boost as the CEO steps down, making way for a reset, and also Lululemon has a decent holiday sales forecast. And then here are, Tilray Brands, the weed company, I guess, out with a new lineup of products, up almost 30% today, and the Round Hill Cannabis ETF also up more than 30%. Let's talk about cannabis ETFs with analyst James Seyffert of Bloomberg Intelligence. James, clearly, a report that President Trump wants to not decriminalize or declassify, but I guess reschedule marijuana as a Schedule III drug rather than Schedule I is helping these assets.
Yeah, 100%. I mean, the way to look at this, right, there's a whole host of marijuana or cannabis ETFs out there on the market, but there's like two that are really purely focused on the U.S. type of market. And that's MSOS and weed, the Round Hill one that you mentioned. And it's because like MSOS is a ticker that seems weird, but it's because it holds only multi-state operators. And it's because there's this patchwork of regulation in the US for marijuana. It's legal in some states, it's illegal federally. And if you cross state lines, it's like you're in this gray area. So these stocks, these ETFs, while they're not going to be the most diversified exposure to the marijuana market, they give you exposure to the names that are most likely to pop on things like, what you just mentioned, changing the scheduling and any sort of regulation here in the U.S. that could maybe open it up federally. So those names are going to pop the most. And weed, specifically from Round Hill, it only holds 5 of those largest MSOs, multi-state operators. All
right, so we'll watch MSOS. They've had a decent year in terms of the gains that we see, especially now. Let's take a look at the decent year that ETFs have had. I mean, every year you and Eric and Athanasios are like, wow, our industry is just breaking new records across the board. This year is no different, and 2026 is also set to be a banger.
Yeah, I mean, so we had our ETFs in-depth event yesterday at our New York headquarters where you are right now. And it was a really successful event, but Eric gave a presentation to look at like what happened so far in 2025. And he basically titled it, "Is this as good as it gets?" Because every record that we look at, every factor, everything we look at is a new record. And it's not just like slightly eking out. It's beating records by 25 to 30% over prior years. And we're not even done with the year yet. So, I mean, we're nearing in on $1.4 trillion of inflows this year. We have record volume. We have record new ETFs. Vanguard is going to take in over $400 billion alone. That's a record for an issuer. The Vanguard S&P 500 ETF is taking in $130 billion. That's a record for a single ETF. I mean, I could keep going if you really want, but everything has been really good for the ETF industry here in the U.S.
Well, it makes sense because the kids just want to voo and chill, right? If you buy that tracker, I guess you're diversified to some extent and good to go. And there are more catalysts to come, right? For ETFs specifically, could we see investors buying them in their 401ks and their IRAs?
Yeah, I mean, possibly it could go more into the retirement market. As you mentioned, like who doesn't love an S&P tracker where you can get it for 3 basis points? It's virtually free and you're getting exposure to the U.S. large cap market, right? So that's what's happening. But it's also we call them degens, the real heavy traders that like to trade on leverage. Lots of those products are coming to market and they're having a lot of success, which is part of why we had a record volume level this year. But yeah, as you mentioned, next year we just got approval for basically any mutual fund can add an ETF share class onto their mutual fund now from the SEC. They're approving these things for a lot of different issuers, so that's a tailwind that could happen. There's a whole bunch of other tailwinds. We're still seeing a lot of movement from legacy structures like the mutual fund moving into the ETF, and ETFs are just continuing to snowball. But one thing I do think is going to happen, we haven't seen a lot of liquidations. I would think that we're probably going to see a lot more liquidations next year because we just saw, as I mentioned, we're almost over 1,000 ETF launches alone in 2025. I mean, the numbers are getting crazy.
James, to be fair, they call themselves degenerates. They are smooth-brained apes, and they are crushing it. James Seyffert, thank you very much. Tune in to ETF IQ on Mondays at 12 p.m. New York time. Coming up, Cam Dawson joins us. She sees more room for stocks to run as more strategists turn bullish. We are 30 minutes into the trading day. Welcome to Bloomberg Open Interest. Happy Friday. I'm Matt Miller. Dani Berger has taken off today. And why not? We hit an all-time record high at the close yesterday. 69.01 was the level. And globally, we're pushing to record highs. Wherever you look, we're seeing big gains, pretty much, in equities. And maybe that's set to continue. A Santa rally trying to take hold as global stocks hit records. But caution in tech remains as Broadcom falls short of some pretty lofty AI expectations. And investors are hearing from a string of Fed speakers this morning as the central bank becomes increasingly divided. But we begin with the S&P 500 on track for a third successive year. Cameron Dawson, Newedge Wealth Chief Investment Officer, says the path of least resistance is higher, writing, "You cannot argue that valuations are cheap, and you cannot argue that earnings estimates are low, but with light positioning, there's still room for a chase higher." Cameron joins us now. Cam, great to have you here in studio. What is or who is driving us higher? Is this a retail play that's driving us up?
Retail is completely all in. We can look at AAII positioning data and you see it at prior peaks like we were back in times like 2018 or 2021. You can look at FINRA margin loan growth. It's grown by 40% over the last 6 months. So retail is completely in. Who's been sitting on the sidelines has been institutions. They've remained either underweight or neutral this market ever since the April lows. So if there is one cohort,
they missed out on all of this. 17%. What? No, it's more from the April lows. Like 38% the rally from there.
It's been extraordinary. Yeah. But what you have seen is that discretionary institutional investors, so think long-short hedge funds, mutual funds, have remained in mostly an underweight position, which just means that as the market continues to scream higher, they get pulled into this market because they need to at least get to neutral and even to overweight to keep up with the performance.
It's like a replay of dumb money, but with the entire broad market.
Yeah.
Can that continue in 2026? I mean, I only hear about tailwinds, Cam, right? I hear about the stimulus coming from the one big, beautiful bill, AI productivity, an increase in that. We don't have any more immigration, so it's not like the labor pool is growing and
there's just really high expectations as we look into the overall earnings growth. And I think what's fascinating is
what are your expectations?
So current consensus is at $309 a share. And what that implies is a 200 basis points of margin expansion and an acceleration in revenue growth. You look one layer deeper on that, what gets really interesting is that revenue growth is implying a big acceleration in everything else and a deceleration in things like Mag 7. So the everything else, that equal weight, is expected to go from 1.5% revenue growth this year to 5% revenue growth next year, which means that current consensus is expecting a strong, very broad-based economy. And the question is that worth giving the benefit of the doubt?
I mean, we're going to talk with Matt Winkler, editor-in-chief emeritus here at Bloomberg, at the end of the hour about tariffs and the costs that U.S. consumers are bearing. $1,000, I think we're looking at this year, $1,400 for the average U.S. household in 2026. So climbing. Are companies passing on these tariff costs, or are they taking a hit to their margins? Because when you say margin expansion, I'm wondering, where's that coming from?
Well, we think it's actually coming from some of this belt tightening and maybe why we're seeing the labor market weaken, because we do know that companies have borne the majority of the costs when it comes to tariffs, but they've been able to hold the line on margins, which suggests that they're looking for cost cuts other places. So when we see the layoff announcements, we're not necessarily thinking, oh, this is AI, this is some big revolution. We're seeing it as companies are looking anywhere they can to defend their margins, which means that even though profits are going up, it means that you're not necessarily seeing the labor market participate in that growth.
This is what my skeptical co-host suspects, that companies are using AI as an excuse to slim down headcount. You see that as the case?
I think it's very likely. From the anecdotes that we're hearing is that AI is a tool, but it's not quite a replacement yet. So maybe at the margin with some of the lower hiring and entry-level workforce, as you see things like college-age workers or right after college age, seeing that unemployment go up. But broadly speaking, we do not think that the weakness in the labor market, as we have seen the slowing in the pace of job additions, can be pointed to because of AI. We think it's margin pressure likely related to more things like tariffs.
Speaking of margin, I think you pointed out that we've seen incredible growth in margin, right? From FINRA data, loan balances.
Yeah.
I guess this is what investors, what these degens are borrowing to get into this market. And to be fair, they're winning right now.
Yeah.
But does that set us up for a fall?
Look, it's an ultimate party on Garth kind of environment where you have seen a lot of leverage being added into this market. You would see it in FINRA margin loan balances.
40%, up 40% in 60 months.
In the last 6 months. You also see it in leveraged ETF volumes. The ETF issuance that you've seen or new formations has all been mostly focused this year on big leverage ETFs, which all says that there is a lot of risk appetite in the retail cohort, which has been rewarded this year because you have seen such strong markets, and you have seen markets led by things like high beta, non-profitable tech, things like ARK, all of these areas that have a bit more of a speculative bent. And a lot of that does rely on expectations that the Fed's going to keep on cutting because you need liquidity and you need loose financial conditions for these things to do well.
Is the Fed going to keep on cutting?
We think that they set themselves up to keep on cutting in 2026. If you look at their unemployment estimate, holding at 4.4% from 25 to 26 suggests that the bar is pretty low for them to say, hey, the unemployment market is weakening more than we thought it would, which suggests that they could deliver those cuts. They also talked about this willingness to look through near-term inflation. By calling tariff-related inflation one time, they're effectively saying we're going to prioritize the labor market versus inflation.
It's just so interesting, and you're not a political strategist, obviously, but
I hope not.
Affordability is such a key issue, right? And yet, we're going to hold these tariffs off, on which the Tax Foundation has said are going to increase costs even more in 2026, and the Fed is going to cut into an inflation cycle that it calls transitory?
Yeah, and now we also have the prospect of medical costs going up pretty significantly as we see the Obamacare premiums potentially jumping. We think the biggest challenge with all of this is that we, as people who look at markets and the economy, we think of things in the terms of second derivatives. We look, hey, the inflation rate is slowing down. But we as consumers, as individuals, we live in this world of levels. And the level is still going up even as inflation decelerates. And that's why people continue to get pressured and feel that pinch from inflation, even though we'll say, hey, it's a win because inflation's slowing down.
All right, Cam, if I get a Christmas bonus this year, where do I put that, after I leverage it, where do I put that new money to work?
So we've been finding a lot of opportunity outside of just big, large cap growth, which of course has been driving this market higher, but things like mid cap, international, and value are all places that if we are to pay for active management, that's where we want to be. Those indices are far less concentrated. There's a lot more difference between winners and losers. So we're finding a lot of great opportunities to add value, look for alpha in those kinds of markets that had been left behind. And I would note that you are seeing a lot of perkiness in some of those areas over the course of the last couple of, or really the last month. We're seeing some pro-cyclical things turn higher, small caps hitting a new all-time high, but we really think it's important to be highly selective in those areas.
All right, Cam, great having you here. Thank you so much for joining us. Cameron Dawson there of Newedge Wealth. Let's get a check on what markets look like heading into the 10 o'clock hour here. We're still looking at losses, but they're accelerating just slightly. And remember, we're coming from the highest level we've ever closed at on the S&P 500 at 69.01. Right now it's 68.72, down 28 points. The NASDAQ off almost 1% as the tech stocks have further to fall. 25,436, the level there. You can see the Dow Jones Industrial Average. I'm glad when the kids are out, we put that up here. 48,791 also hit, as President Trump pointed out, a record high. And the 10-year yield right now at 418.41 to go out five significant digits. It'll be interesting to see where that goes through 2026. Let's get a look at some of the single stock stories this morning. Broadcom delivered a sales outlook for the AI market that failed to meet high expectations. It has a backlog of AI orders totaling only $73 billion. Lululemon boosted its profit forecast and said the CEO, Calvin McDonald, will step down in January. Plus, pot stocks jumping higher on news that President Trump is expected to direct his administration to reclassify marijuana as a less dangerous substance. Tilray also apparently announced a new product line, if you want to check it out. Coming up, Wealthfront raising more than $480 million in its IPO. We'll speak to the company's CEO about how he changed the landscape of money market funds next. This is Bloomberg Open Interest. Now to high interest, look what's making headlines around the world. New Jersey has declared a state of emergency as a major propane terminal outage threatens winter heat for nearly 186,000 residents. With temperatures freezing, the state is waiving trucking limits to rush fuel where it's needed. Suppliers are rationing loads, and long wait times are growing, raising fears of delays for home heating across the region. Millennium Management is putting over $3 billion behind two outside hedge fund teams. The London-based Fulcrum without another R, maybe? Fulcrum Asset Management will receive about $2.3 billion to run an exclusive equities unit. Another $850 million will go to Armar Capital. It's the latest push by Millennium to seed fresh investment talent across its multi-strategy platform. And NASDAQ is tightening its listing rules, giving itself new discretion to reject small-cap IPOs, even if they technically meet the requirements. The exchange can now waive red flags like company location, board integrity, and advisors linked to past problematic trades. The move aims to curb extreme price swings and manipulation seen in recent micro-cap listings, especially from overseas issuers. Let's stick with the IPO market. Fintech company Wealthfront raising $486.6 million in its IPO. The company, which is best known for its automated investing products and online platform that's attracted younger customers, is set to trade under the ticker WLTH on the NASDAQ. And joining us now is the company's CEO, David Fortunato. And David, I think it's a fascinating thing what you've done, what Wealthfront has done with money market funds, getting investors a real return on savings that they can still use to do things like pay the rent. Do you see it as a sea change in money management?
Well, the way that we think about it is really by using technology and automating solutions, we're able to share more savings with clients, ultimately keeping more, clients get to keep more money in their pockets and they get to do more with their money. We're quite happy to operate on smaller margins, and we think that leads to better outcomes for the folks who use Wealthfront.
I wonder what you think about the new Trump proposals. Well, they're not really new, but the Trump investment accounts, bringing in a new generation of investors. Obviously, for those specific accounts, they have to be born now. But if you look at the money that Michael Dell gave, that's for kids up to the age of 10. Are they going to be attracted to platforms like yours more than they will be to the incumbent banks on Wall Street?
One of the things that I think is surprising for folks about Wealthfront is that our new clients are coming in with a median age around 23, 24 years old. So a lot of young investors are getting started. They're interested in low-cost, globally diversified, tax-efficient investments. And we see that as an opportunity to get clients started early and really compounding their wealth for decades to come.
What are you going to do with the money, David? How do you grow Wealthfront with the proceeds that you've got?
We're focused on product development. Really, we've been a product-led company from the very early days, and so we see opportunity to continue to expand. You look at one of the products that we've started releasing over the last month is home lending. So helping folks get a great digital experience as they buy a home and save some money on their interest rate as well.
We saw at one point, I think Wealthfront accounts were yielding 5.5%, close to 6%. If you had brought in, other customers, you got a huge boost, and you still do. But that rate has come down to the 3s, maybe 4, if you reach with those incentives. Is it still going to be as sticky as the Fed cuts rates?
What we've seen is stickiness of clients. We don't focus on exactly what accounts assets are in. We focus on keeping clients engaged on the platform and growing their wealth over time. And so 75% of our assets are held by clients who hold investment accounts on the platform. As rates have come down a little bit, we have seen assets shift into investments. We think that's ultimately good for clients long term to be able to compound their wealth, over the next many years that they're on the platform.
How can you beat out the competition, because there's a lot of it, with robo-advisory services. You know, how much can you do with AI, or do you still need to rely a lot on humans?
Well, half the company is software engineers. We've really been a technology-led company from the very early days. We focused on new technologies and pushing out new products to clients. Really, that's been the focus of the company from the beginning. I was the CTO for 10 years. I built our trading infrastructure and data infrastructure. And if you look at our investment products and our client experience, really leading with technology is the core of how we think about things. When we do human support, you know, we have a great team that answers the phones and sends emails. But really, we see that as a way to prioritize to make our product better. If a client needs to call us, it's an opportunity for us to get better, and that's how we approach it.
I guess I focus on cash management, that portion of your business, but as you're saying, like, you've got a much broader portfolio of offerings, investment advisory services, financial planning, lending products, technology. What about your client? I mean, I'm sure that's just as diverse, but what does your average customer look like in terms of demographics, wealth, sophistication, et cetera?
Sure. Our median client is 35 years old today. They make $165,000 a year in annual income. They have about $250,000 of net worth. They're saving every month consistently, often putting away a few $1,000s a month and growing their wealth on the platform. We're investing it across a globally diversified portfolio. We're helping them earn more on their cash. We're providing them with quick liquidity through our portfolio line of credit product, where you can borrow against your securities for less than 500 basis points. So we're really trying to offer our clients a better deal in everything that we do.
Yeah, I hear almost a Vanguardian client service ethic there, and it makes sense. Burton Malkiel, your chief investment officer, focuses on that. Obviously, the writer of A Random Walk Down Wall Street as a financial news anchor for 25 years. I've been thinking about him for that long. How much influence has Burton had on your business?
I mean, Bert has had a huge influence on our business even before we started. You know, when I was 12 years old, I had a paper route and opened my first account at Vanguard to be able to start saving in my IRA. It certainly influenced me and how I think about investing. We're incredibly fortunate to have Bert involved with the company. He's really been a guiding light for how we think about what products we want to get into and how we want to present them to clients. And you know, he's fierce. He cares a lot about what we do and how we do it, and it's been great to have his voice of wisdom with the company for so long.
Some of your competitors, when they do IPOs, fintech companies often give a special offering or share allocation to their large base of customers. You didn't do that. Why is that?
We're a fiduciary to our clients on investments, and you know, the guidance that we've put out over time is that investing in IPOs can be a risky prospect. We really emphasize passive, diversified investing. And while we understand that many companies have given clients allocations in the IPO, it really sets up a dangerous conflict of interest precedent, and we really wanted to make sure that folks, you know, we were consistent in the way that we do things across all of our investment guidance.
One of the risks, by the way, to businesses like yours, like Schwab, like Robinhood, SoFi, is that they're very sensitive to rates, right? And that's a moving target right now. How do you diversify away from that?
So the way that we run our program is a little bit different. You know, many broker-dealers gain a higher spread and make more revenue when rates go up, and then they lose that revenue when rates go down. In our case, we seek to maintain a fixed spread relative to rates. So as rates are going down, the total fee rate that we earn on cash has remained consistent throughout both the cuts that happened in 2024 and the cuts that have happened recently. As we've been able, you know, to see rates come down, we've actually been able to drive cross-product adoption and see additional assets flow into the platform to help clients invest. So, you know, we think about the diversity of product offerings as really the strength in growing throughout the cycle, and it's been a focus of the company since 2019. It's why we first got into cash management in the first place.
So are you not concerned that and I've kind of asked you this already, but I'm trying to get your outlook on rates, your outlook on the Fed, what you expect, you know, as they cut at the short end. Obviously, we haven't really seen much of a drop in the 10-year. So how do you see the curve helping your business, and how do you forecast that out into 2026?
Yeah, so we don't try to predict the future. I think, you know, we have no expertise in predicting rates. Instead, what we try to do is prepare our clients for the future and many possible things that could happen. during the period in November and December, the yield curve normalized a little bit. And what we saw was clients loved our automated bond ladder product, which let them go out on the yield curve and get a little bit more yield. If the yield curve normalizes, we expect that product will do well. If the yield curve stays inverted, we expect clients to continue putting away money in cash and continuing to invest for the long term. Rather than focusing on one environment and trying to optimize our products for the current environment, we're focused on offering a portfolio of products that can continue to grow throughout the cycle.
Well, David, it's a truly fascinating company, a fantastic IPO today. Congratulations on that. Hope we can get you here in the studio to talk more about it. David Fortunato of Wealthfront. Now, obviously, we don't necessarily see that trading right away, but the shares indicated at $15.50. If you're following the IPO, it was at $14, and we'll bring you the trade as soon as they start to tick. Still ahead, we're going to speak with Brown Harris Stevens CEO Bess Freedman about her outlook for luxury real estate in 2026. This is Bloomberg Open Interest. Get a check on the stock market right now, almost an hour into the session. We've got the move screen up over here, and you can see that we have steadily come further down throughout the first hour of trading. We still have breadth to the upside, 279 gainers, only 221 losers. And you've got some big names on the top, but General Electric adding the most points doesn't really instill confidence here. That's because Broadcom put out earnings that kind of freaked out investors a little bit, as evidenced by the 10% drop. It's taking 23 points off the S&P right now. And you got Amazon, Microsoft, Nvidia, and Google, Facebook all falling as well. Coming up, Manhattan rents skyrocket, hitting an all-time high with stocks. Manhattan rents surged to an all-time high. Data from appraiser Miller Samuel and brokerage Douglas Elliman shows the median lease price in the Big Apple hit $4,750. It's a 13% jump from just 1 year ago. Joining me on set is Bess Freedman, CEO of Brown Harris Stevens. Brown Harris Stevens is a luxury real estate brokerage in the New York metro area as well as South Florida. So you're focused more on the higher end of the market, but inflation is just crushing us. Yep. The rent is too damn high, as someone once said. Can anything stop it?
I think it's going to take time, as we reset a little bit. We've seen more sales this year, which has been good, but there's a lot of pressure on rentals. And as people want to move here, they got jobs here. It's the talent capital of the world. Rents keep going up, up, up as people pause on the purchase avenue. They're just waiting to see what's going to happen with rates, with everything in the economy. Are we headed for a recession? All these questions loom. And so the rental market is a place that people can temporarily live and make decisions later on. So
what about your clients? I mean, people who are buying high-end real estate, they don't have jobs, right? These are just people with a ton of cash.
Yes, that's discretionary. And thankfully, even post the mayor's race, that market has been incredibly robust. People have not stopped. They have
really?
Not...
I thought everyone was leaving New York after this communist won. Wasn't that what we heard? Isn't that what everyone said?
That's what everybody said, but that's not what happened. In fact, we didn't skip a beat. The market has been really strong. People have pursued and bought and closed, and we're seeing a really strong luxury market because people made a lot of money in 2025, and that's a different market, obviously.
But you are in, if we do see an exodus from New York, those people are going to South Florida, another market you're in, right?
Yes.
So you're in a great position to tell me about the flows.
Yes.
Are we still seeing that flow south, or any of them coming back?
I mean, we have been seeing that in drips and drabs, and we're not seeing anything substantial. People do move to the south for other reasons, because they retire, because they want different weather, because they got a job there. So we've seen a little bit of that, but there's been nothing that is remarkable. People have returned to New York.
Yeah, that's what I'm wondering about.
Yeah, people want to be a part of New York City. I mean, look at the tourism percentages. Look at the office space. Look at people are back to work. The city is doing really well.
Do you ever see people getting back to work at a pre-COVID level, like going into the office, or are we in a new era?
I think that
hybrid work.
I think that maybe a Friday, working from home has been okay, but I think people are saying you got to show up. You can't build culture on a Zoom. You got to see the whites of people's eyes, see how they're doing, check in with them, and talk to each other. And I think the companies that are committing to that are building a real future for their, whatever they're building and doing.
I'm going to talk to our economics and policy correspondent in a minute about Fed speak. And obviously the Fed has been cutting 75, 100 basis points now. Does that matter to your clients?
I mean, look, New York City in particular is a big cash place. I mean, people buy their homes, a lot of them in cash, like 60%, I think we saw. But yes, of course, it all matters. It matters for consumer sentiment. They want to know that rates may come down, but it's not going to be anything meaningful. It was 25 bips. It's not going to make a big impact on mortgages. And I think that it's really an affordability issue that we face throughout America that's a bigger topic of discussion that we need to solve for.
By the way, why is the New York market so cash heavy? Is it just because they have the money, or is it because they want to go into a co-op and the co-op wants to make sure that they don't have a big mortgage?
Well, of the housing stock that you can buy in New York City, the majority of that, nearly 70%, they are comprised of cooperatives. And yes, there are certain requirements, but this is a discretionary market. It's expensive to live here. It's expensive to rent here. So people tend to, spend cash because it's a pied-à-terre market as well. It's a second home, a third home market.
What are the hottest places right now? Where are you doing your best business? Where do people want to go and live?
I mean, all over the city, but the Upper East Side is like they're saying uptown is the new downtown.
Still?
Sorry, it's not just because I live there. I'm not selling my book to you, Matt. I promise you, the Upper East Side is where it's at. I mean, downtown is always hip, but there's all these new places that have opened up on the Upper East Side. And you have parks, you have schools, you have temples, you have everything that people want. So, but the city all over is great.
And the boroughs, I mean...
Brooklyn is super hot and strong. The townhouse market there is incredible. It's just, we're moving out further to different places because there's no room for everybody.
Are you worried about the new mayor at all? I mean, what about your clients that own properties they rent out, right? You have, say, like some Saudi oil billionaire in here. He's got a whole building. And is he worried about price caps?
I think that's, for the rent regulation, that discussion is scary because people won't improve those apartments if it happens. But I think it's going to be harder to do than what he says. And I think, people have to give him a chance. We have to give him a chance. I care about good policies, not labels. I don't call yourself whatever you want, but give me good policies and we'll have a great city.
Bess, it's great to have you here.
Bud.
I hope you have a fantastic holiday.
Thank you.
Bess Freedman there of Brown Harris Stevens. Quick check on what's going on in the markets right now. We have seen a decline in the equity indexes, and that continues. So the S&P 500 now down 0.7%, 68.53. However, we were at 69.01 yesterday at the close, an all-time high. The Dow Jones Industrial Average also an all-time high, 48,735. The Nasdaq taking the biggest hit, down 1.4% on the Broadcom earnings story. In terms of the Fed, we got fresh speakers this morning. Statements from Austin Goolsbee, statements from Jeff Schmidt, who both dissented against the central bank's decision to cut interest rates this week. Let's break it down with Michael McKee, Bloomberg's international economics and policy correspondent. Mike, what were the reasons behind those dissents?
Well, Beth put her finger on it when she said there's a nationwide problem with affordability. The two dissenters basically saying it's inflation that is bothering them because they've been out talking to their constituents in their districts. Austin Goolsbee saying today, almost all business people and consumers we have spoken to in the district lately identify prices as a main concern. My unease is about too heavily front-loading rate cuts and just assuming that inflation will be transitory. And then Jeff Schmidt adding, I continue to hear concerns about inflation. I view the current stance of monetary policy as being only modestly, if at all, restrictive. Now, they have voted at their last meeting for this year. They roll off next year. Two new members are coming on. And they're pretty much in the same boat, maybe a little more mixed. We did hear from Anna Paulson, the Philadelphia Fed president, who said she's still more concerned about labor market weakness than about upside risks to inflation. But then Beth Hammack from Cleveland, a hawk, says inflation has been too high. It's been much closer to 3% than 2%. I would prefer to be on a slightly more restrictive stance. So it doesn't look like we'll have much change from the rotation of the Fed presidents. We are looking at people coming on who are also worried about inflation, but inflation is what the people are telling the Fed is their concern.
Well, you know what's interesting is that it's not just the Fed's dual mandate, but there's this conflict between what's worse for consumers, higher unemployment or higher inflation, right? And I remember when a couple years ago, Joe Stiglitz came out and said, look, inflation is far worse and it's killing these people, but obviously if you don't have a job, then to you at least, the unemployment rate is more of a problem.
Yeah, exactly. But the situation is we still have jobs. The unemployment rate is historically low still at 4.4%. We'll see when it comes out on Tuesday. But we are not seeing big layoffs. We're not seeing people forced out. And so at this point, inflation continues to bother people much more. And you see that reflected certainly in all the polls.
What are the expectations? On Tuesday, we get non-farm payrolls, the delayed report. What are the expectations for that, and does it matter to the Fed going into 2026?
Matters less than people might think, even though there's been a big deal made of how much data we have not gotten, in part because they're combining the October and November releases, and they won't have all of the October data, so there'll be some blank spaces in there, and it'll be kind of hard to measure what the progress was. Right now, the consensus is for 40,000 jobs created essentially over the 2 months, but Jay Powell said on Wednesday that the Fed thinks that's overstated, so it could actually be negative. I think what we have to do is wait until we get the December payroll figures on January 9th, and that will be the number that will really matter to the Fed as they consider what to do at the end of next month.
Mike, Jay Powell and you, both big deadheads, and there's no dead shows planned that I know of right now, but obviously Phish is coming to Madison Square Garden. Will you go and see a Phish show because you just need that live music?
I think there's probably a good chance of it. The Phish is also going to the Sphere.
Yes.
So even if the Dead aren't playing there, we could go out to that and get our, well, you don't get the same experience, but you get the good jam band experience.
Yeah, I think it would still be an eye-opening, like a Drew Carey kind of thing at the Sphere.
But we want to know what the ticket prices are because obviously inflation matters.
But I'm sure you know, what are the ticket prices? They're like, it's like $1,000 to go see Phish at the Sphere, right?
Yeah, something like that. It's well, the Sphere is very expensive, but
right.
It's a worthwhile show. I will put in a plug for the Sphere.
For the actual building, you're saying?
For the building, yes. The experience of a concert.
Well, and apparently the Phish show is insane there because they really tailored everything to that venue.
They should really just do Phish and Dead back to back.
Yeah, I agree.
Over and
I
over
agree.
again.
The Dead and Company should come back. Michael McKee, their international policy and economics correspondent and resident Deadhead, coming up to share or not to share. Wall Street Week weighs the risks and rewards of open sourcing information in the age of AI. This is Bloomberg Open Interest. Time now for our Wall Street Week conversation. In the age of artificial intelligence, is open sourcing information a catalyst for innovation or an opening for bad actors? David Weston sits down with AMD Chair and CEO Lisa Su to discuss what's really at stake.
Lisa Su is chair and CEO of AMD, the chip maker with hundreds of billions of dollars at stake in the development of AI. When it comes to the software that runs on their products, she and her company have made their choice in favor of open source technology, sharing where they can.
The difference with open source or open standards is the idea that you set out a set of standards that people can follow, and then different companies can choose to implement in a different way. And the whole idea is to provide platforms that the entire ecosystem, lots and lots of developers can develop, and that you can be able to interchange sort of the best of breed from different sources.
Why is there so much passion around open I mean, is it a matter of business or is it a matter of philosophy?
The philosophy is, do you believe that there's any one company or any one group that will have all of the best ideas in the world? Or do you believe that if you have an open ecosystem where different researchers and different groups can contribute, that you will end up with a better product overall? And philosophically, I think, from an AMD standpoint, actually, if I think about, throughout my career, I look at, sort of the different inflection points on technology. Things often start, new ideas often start in a closed environment, but when you actually think about when they get big and when, a lot of people adopt, you like to be in an open environment. And, that's philosophically. Now let's talk about the business aspects of it. The business aspects of it are, we all have to make choices of where we invest. And do you want to trust, all of your crown jewels and all of your data in a closed ecosystem that, may or may not be the most competitive at any given time, or, may have, a flaw or any of those things. Whereas, in an open ecosystem, you have choices. You can decide who is the best at any given time. You can decide, if I have my data in a cloud environment, I can easily move it to another environment. If I have my applications that are built on one chip, if there's a better chip, a few years later, you can move, quickly. That's kind of the idea of both.
What, broadly speaking, are the advantages of open? And let me throw one out. For example, in a new technology, is it more likely, all other things being equal, that the technology will develop more quickly if it's open?
I would say that the main advantage of an open ecosystem is that you can get many, many more developers on that ecosystem, and they will contribute, sort of in their, special way. So, an example I can give you is, when we think about supercomputing, like the largest supercomputers in the world, we usually like to develop them on open software stacks so that researchers from all different labs can actually contribute to those applications and those learnings.
That was David Weston speaking with AMD's Lisa Su. You can catch Wall Street Week every Friday at 6 p.m. New York time. Coming up, Bloomberg's Matt Winkler says American families are getting a lump of inflation for Christmas to the tune of $1,000. He joins us next to talk about this tariff-driven increase in prices. This is Bloomberg Open Interest. Let's take a look at what's ahead for markets. Next week, Tuesday, November payrolls. That's the delayed report we were talking about with Mike McKee and October retail sales. Wednesday, the latest earnings from Micron, so we'll get a read on DRAM. Thursday, we get U.S. CPI data and rate decisions from the ECB and the BOE, plus Nike and FedEx report results. At least one of those really a bellwether for the economy, or has been in the past. Finally, next Friday, we'll get a BOJ decision. Increasingly important to pay attention to that, and the University of Michigan consumer sentiment out. And sticking with the consumer, in his latest column for Bloomberg Opinion, our editor-in-chief emeritus, Matt Winkler, writes about the impact of tariffs on your holiday gifts this year, really, and next. It's going to cost $1,000 more for the average U.S. household this year. Matt joins us on set, I'm happy to say. And that cost, that increased tariff cost, is going to rise in 2026, according to the Tax Foundation, to $1,400. Why is the administration telling us something completely different?
Who knows? I mean, it's total chaos. And what's really sad about this is that while big corporations have a way of dealing with this, and we've seen that already, it's really individuals and small business. And small business is the backbone of the American economy that is getting punished. And one of the ways we see this is for example, Dallas Federal Reserve Bank does a survey of its economy. And Texas, of course, is the second largest state in the country. And business across Texas are suffering because of the tariffs in all sorts of ways, mostly because of uncertainty, but they don't really have any recourse. And as you say, what all of us are finding out is if we buy anything, say online, that comes from somewhere else, Canada, for example, the UK, for example, in my case, we're going to find out to our surprise. And it's really going to be unprecedented. For me, it was a shock that I get this letter from United Parcel Service. I never got a letter before from United Parcel Service, and I thought it was a scam initially. And then I see government charges, brokerage charges, and I'm thinking, what is this? And then I realized it was for a relatively minor purchase in the UK, a specialty item, happened to be, by the way, bow ties. And I find out that I'm going to pay that magic number 10. As it turns out, above and beyond what I normally would pay.
10% more.
Yeah, exactly.
And you know what? There were two things about that anecdote that I found fascinating. Number one is the obvious. It wasn't the UK exporter that was paying that bill. It's you. It's the end buyer, the consumer. And number two is that you had, for some unexplained reason, different tariffs, what, on each bow tie?
Yeah, it makes no sense because they were exactly the same. And, you know, I'm teaching a course next year at a university, and I just wanted to have those ties because it's that university, you know, to present to people. And they're all the same.
Columbia or Kenyon?
No, it's Berkeley.
Ah, okay, so a completely different. I always connect you with Kenyon because of our shared Ohio roots. In the Supreme Court, there are currently arguments about this tariff policy and whether Trump can use IEEPA to put tariffs into effect or not. One of the weird arguments I've been hearing from the administration is that if these tariffs are reversed, refunds are out of the question because that would be too complex. But as your case illustrates, it's just the importer who pays the tariff. So do you think that's a reason that we wouldn't have to pay refunds?
You know, I have no idea how this is going to resolve itself. All I can tell you is that it's now chaos, and I can't see how, regardless of what the Supreme Court does, even if it rules that the tariffs are in fact unconstitutional, as courts have already ruled, how this gets resolved to my benefit, your benefit, anyone's benefit. I don't see it. And you know what is so sad about this? It's Americans punishing Americans.
Yeah, I mean,
that's really what it is. It's Americans punishing Americans. It's truly proud to be stupid.
That's all right. So the counter argument, Matt, I mean, not to that, but to the concern on tariffs is that markets are at all-time highs, right? Growth looks pretty solid. Unemployment may be going in the wrong direction, but still 4.4%. When does this catch up to us?
So wait a second. I think I'd have to qualify what you just said. Yes. The rich are getting richer. The most powerful are becoming more powerful. The stock market reflects that. On the other hand, if you look at where inflation is, it hasn't come down. And it would have come down had we not had these tariffs. That we were on a glide path to lower inflation in 2025 before we had the tariff imposition. So people are paying already, Americans, most Americans are paying a much higher cost than they otherwise would. Stock market doesn't really mean much to them. And the outlook is not actually favorable. You just had Fed officials say, in fact, this week, that there is a hesitancy to see lower interest rates because the tariffs have raised inflation. Another thing that you're seeing is the dollar continues to get weaker. Why are bond yields going up? Yeah, when the Fed is easing credit, bond yields are going up. Why are they going up? Because the whole outlook for the U.S. economy is becoming more precarious. And who better, by the way, to tell us that than Paul Krugman? What did he receive the 2008 Nobel Prize in economics for? Precisely this issue, tariffs and trade.
Yeah,
and he has called this an unmitigated disaster.
Well, I mean, and I think your Dallas Fed point is also important because whereas Paul Krugman is clearly a Democrat, this is a red state where they're having significant problems with these things. I highly recommend people check out your column, Matt Winkler, editor-in-chief emeritus here at Bloomberg, writing on inflation for Christmas. Coming up on Monday, Kate Moore joins us from Citi, Ethan Devitt of Moneta, and the CEO of Angara. This is Open Interest.